A window of opportunity can shut in front of most XRP holders' eyes in an instant, and it shuts down the second that regular people can no longer afford to invest in the markets. I don't want you to make the same grave error that the other 95% of XRP holders will make when I lay out all the facts and figures. Almost no one is willing to hear this, yet that is the truth. Nearly no one is in a good position to make the actual XRP move. No one doubts that they will just restock on XRP in the future. They will patiently await market corrections and dips, trade their positions under the false impression that they are being clever, and convince themselves that there will be another opportunity. You must be a member of XRP Insider's elite if you intend to take advantage of the next big financial change before it happens. Get the inside scoop on XRP, learn the frameworks of a millionaire mindset that create wealth that lasts generations, and learn the exact tactics used by the top 1% behind the scenes. All premium resources are at your fingertips too. Get 10% off with the code MILLIONAIRE. All the details are in the video description down below, because this is something that very few people grasp. The real movement of institutional markets is nothing like this illusion of waiting for prices to drop before buying. Many believe that XRP timing will be as straightforward and predictable as trading other cryptocurrencies. They think they can get out at the top, sit tight until the market crashes, and then re-enter at a cheaper price, as if nothing had occurred. Plus, they have complete faith in that strategy that they don't bother to doubt its validity. Even with all my experience and resources, I failed to sell XRP above $3 to purchase it back later. I manage a private trading club and am in the crypto space all day, every day. Why? Reason being, price fluctuation isn't the main threat to the XRP market. Liquidity is vanishing before your eyes as you patiently await the ideal moment to enter. This is the one slip-up that will cause 95% of XRP holders to lose money. The buy-the-dip mentality is harmful in addition to being incorrect. The declines in value of most assets follow regular patterns that are based on the cyclical nature of the market. On the other hand, XRP is no longer behaving like a commodity asset. It's changing into a liquidity product fit for institutions, and that affects everything. As a market moves away from being driven by retail and toward being driven by institutions, price becomes less important. The true front line is liquidity, which ordinary investors completely ignore. The tremendously risky premise of the buy-the-dip mentality is that centralized exchanges will perpetually maintain liquidity and be accessible for your re-entry. This is not the case, since large institutions can quickly deplete the supply of XRP before individual traders can buy it. Finally, the most crucial aspect, no one should expect them to come out and say it. They have no plans to tweet about it. They have no intention of informing the news. They will not inform you that the final opportunity for a low-cost entrance is rapidly approaching. The tendency is the same whether one examines the accumulation of BTC from 2011 to 2020. Massive amounts of Bitcoin were covertly purchased by big financial organizations and funds while its price was below $1,000 and even $10,000. Concerning the public, nevertheless, what were their claims? Bitcoin was being seen as a fraud by them. Bubble was what they were referring to. They warned you not to go there. They were publicly shaming the very thing they were doing behind closed doors. Retailers were priced out indefinitely before they even recognized what was occurring. Bitcoin prices below $200 are currently unattainable. Not even close to $1,000 will get you it today. At $10,000, it's out of your price range right now. Those that lingered for an additional plunge failed to notice the full maneuver. The liquidity window closed before they could make a judgment, not because they were incorrect about price movements. Now do the same thing with XRP, but with much bigger entities. XRP is no longer traded in the conventional way. As a future global settlement rail, it trades like this. Retail traders randomly scalping 5% candles aren't the true buyers. Who cares about your feelings or getting in at the perfect moment? Global money movers, funds, banks, corporations, treasuries, ETF desks, liquidity providers, custodians, and so on. They don't think things will go backwards before acting. An attitude of get as much supply as you can before anyone else wakes up governs their operations. For that reason, this is a pivotal moment. Everything moves at a breakneck pace once a market enters its institutional phase. As a result, the market depth decreases, supply decreases, order books shrink, and price starts to reflect scarcity instead of speculation. At that point, retail becomes permanently out of reach financially. XRP's price of $10, $20, or $100 won't change things. When there isn't enough XRP for exchanges to sell to you, the retail market becomes priced out, the point at which the current circulatory supply is equal to or less than its historical value. Once trillion-dollar settlement flows take the lead in driving liquidity, weekend traders will no longer be able to compete. This is the most painful aspect. As long as they keep their eyes on the charts, retail will continue to act normally. RSI will be on their radar. A look at moving averages is in their future. Support zones will be under their watchful eye. However, a supply shock will go unnoticed by the chart. Eliminating liquidity is not something that technical analysis can foretell. When the last cheap XRP is sold, you won't get a notification from an exchange. Even after market makers have left, Coinbase would not inform you. One day you just wake up and remember that one crucial window, you missed it. Most people think they'll be able to spot red flags. They are anticipating a major announcement. In their view, institutional buyers will be deliberate and obvious. However, accumulation does not function in that way. It occurs invisibly. Assuming no one else is paying attention, it occurs. It occurs as retail professionals engage in heated debates on social media on price estimates. And it's already over by the time you realize anything is occurring. The true peril starts here. Why? Because the majority of individuals have no idea how exchanges factor into that calculation. You are not engaging with the same liquidity institution when you purchase XRP on an exchange. You're engaging with the most limited pool that is currently accessible. That pool will be the first to dry up in the event of a supply shock. Retail becomes trapped because of that. After a market shift, most people just don't go back in. And the most significant danger of all, not even self-custody is practiced by most XRP holders. They maintain transactions. Instantaneous demonetization may occur in the event of a liquidity event, regulatory freeze, solvency problem, or structural drain. It was proven by FTX. All of a sudden, billions of dollars worth of user assets disappeared. Those who believed they were secure found out the hard way. Their assets were never reclaimed by the majority of them. Afterwards, the subject of what causes the XRP supply shock naturally arises. Because if you get this part wrong, you'll have no idea how fast things can change. A dramatic event is what most retail investors imagine. Imagine a future where world leaders gather for a press conference to announce a huge announcement, a worldwide shift to XRP, and Ripple is on stage. They picture news stories flashing by, pricing charts erupting, and complete chaos as a result. Important structural changes, however, do not occur in that way. Until they are finished, transformations in financial infrastructure are unobtrusive, dull, and silent. It can take months, if not years, for the back-end infrastructure to be up and running before the public notices the front-end effect. That is crucial. When the news becomes public, the XRP supply shock does not start. The clock starts ticking the second financial institutions begin secretly testing, piloting, and routing actual transaction volume over the XRP rails. The true building occurs during this subtle ramp-up phase. Reason being, consider this. There can be no last-minute liquidity sourcing for banks. Before the system can be scaled, liquidity needs to be ensured. Therefore, serious purchasers who intend to direct large settlement flows will need to stock up ahead of time. Stress testing must be conducted. Throughput must be modeled. They need to make sure that money can be reliably transferred between rooms. They can't pull that off without a substantial quantity of XRP. This is why supply is quietly absorbed by institutions. They need to get ready before the market figures out what's going on. Also add something that the majority of people don't think about. Contrary to popular belief, the amount of liquid XRP is quite little. There may be billions, but only a tiny portion is actually tradable. Everything else is either unavailable for purchase, is in the hands of long-term entities, or is locked. Institutional buyers aren't up against millions of individual traders when they step in. They're vying for a small portion of the quantity that is available. A supply shock is created in this way. $1 trillion won't be needed. It is not necessary to include every single bank globally. A small number of significant actors acting simultaneously is all that is needed, particularly if they are all evaluating potential new passageways or getting ready for future settlement activities. Additionally, this is the reason why the conventional wisdom about waiting for a drop is no longer applicable. Dips occur in a retail-driven market when buyers' fears cause a temporary drop in price. However, institutions do not sell out of fear when they purchase. Volatility does not cause them to liquidate. They refrain from selling during market downturns. Building infrastructure is why they're holding on. What this implies is that the typical market cycles are becoming less effective, with smaller dips, shallower corrections, less liquidity, and a higher market floor. Unless the purchasers are dispassionate day traders, you should expect to deal with organized financial companies that have long-term strategies in mind. All right, let's move on to something even more important. Transactional liquidity demand. This is the part that the majority of people fail to really grasp. Don't think of XRP as an asset. It enables liquidity. There is no longer any room for speculation in the demand for liquidity as adoption increases in scale. The foundation is functional throughput. Holding sufficient XRP to settle daily flows of $500 million is essential for any firm looking to establish an XRP corridor. As soon as you include in other routes, partners, institutions, and potential use cases, the demand starts to grow at an exponential rate. Because retail only considers investments, here is where they are caught off guard. Is $10 the ceiling for XRP? Is $100 in the cards? The upside of investments is irrelevant to institutions. Liquidity performance is important to them. They can't manage volume without sufficient XRP. Consistency is key for them. Their depth is lacking. Then they make their purchases. The retail industry is cut off due to this mentality gap. Institutions don't speculate on prices when they accumulate. They do it out of need. Furthermore, consumers who are in a state of dire need will always outbid retailers. They move quickly. They are fearless. Fear and greed indices are not considered. They only get what they require. Proceed to apply an additional layer atop this: clarity and regulations. In the minds of most individual investors, regulatory clarity is a discrete event, the time when all doubt is replaced by certainty. Clarity and regulations, however, develops with time. Institutions start taking silent stands, legal language gets stricter, frameworks get clearer, and precedents are created long before the general public grasps the significance of these shifts. More types of institutional investors, including family offices, hedge funds, custodians, banks, ETF issuers, and corporate treasuries, become available as regulations become clearer. Those purchasers aren't warning retailers either. Their intentions remain undisclosed. They gather in quietness. The idea of on-chain visibility is one of the most baffling parts of this whole change. The retail sector is operating under the assumption that the blockchain will reveal institutional investors' massive XRP purchases. Unfortunately, retail exchanges aren't where institutions shop. They obtain funds using over-the-counter means. They buy things through informal agreements. They buy from brokers, liquidity partners, and custodians. They engage in transactions in such a way that the market doesn't show any obvious signs of distress until after the fact. The retail industry is always caught off guard by this. Additionally, there is an additional layer that is seldom discussed: redirecting cash flow. To keep up with demand, liquidity needs to change as new corridors go live and more institutions start settling with XRP market makers tweak. Rebalance the order books. Liquidity centers in different regions take in more supply. Dislocations in prices can occur momentarily as a result of this. Sometimes it causes unexpected pauses. On occasion, it causes XRP to vanish from exchange availability without causing a significant price surge, a phenomenon known as a silent liquidity drain. A supply shock is only starting to unfold, that which does not appear to be there, the portion that stores disregard, the portion that is not represented in graphs. Impact of custodial migration is another element that is hardly anticipated. It is unusual for institutions to hold XRP on exchanges after they onboard it. It is then transferred to cold storage, controlled institutional wallets, or custodial vaults. When XRP reaches these zones, it essentially disappears from the market for liquid assets. It isn't making the rounds. Nobody's trading it. It isn't adding to the depth of the market. It's not open. The liquid supply drops once a sufficient amount of XRP transfers into long-term custody, allowing the price to rise with minimal buying pressure as the market becomes thin. Because of this, the supply shock has a significant impact. One institution is not the focus here. It's about the sum of all the institutions achieving stable positions at the same time. The psychology of consumer reactions in stores should also be considered. People who invest for fun often act on their emotions. Green candles are pursued by them. If the price remains stagnant, they will panic. They anticipate regularities. However, this is not how institutions think. Their planning spans years. They build up with time. They remain unmoved by news reports. They respond to plans. Institutions amass while retail hesitates. The order books are bought out by institutions when retail hopes for falls. Institutions take action based on private data, strategic relationships, settlement testing phases, pilot program timetables, and internal demand predictions, while retail waits for confirmation. Confirmation reaches retail after the door has already closed. Last but not least, the trigger. The supply shock is not due to exaggeration. This is not the result of conjecture. Neither influencers nor predictions are to blame. It happens when the demand for utilities exceeds the availability of liquids. As soon as demand exceeds supply, the price starts to diverge from the norms of conventional trading. Shortage and need become its motivating factors. Your money is not being advised by this. The whole accessibility scene will shift when the XRP supply shock hits. Most people just assume that tomorrow will be the same as today. Therefore, they never give this much thought to the future. The exchange is open around the clock. There's plenty of liquidity, full order books, and XRP is ready for customers anytime they are. However, once transitioned from the retail market to the global infrastructure layer, transformative assets do not act in that way. When exchange liquidity suddenly disappears, ordinary investors are struck with a slew of serious implications. The first stands out as the clearest. It is now difficult to purchase XRP. You can see the price, the chart, and the news, but you won't be able to access it when it's most important. This was also the case when Bitcoin was first starting off. Institutions' enormous BTC holdings didn't merely price out regular investors. These were sliced. The stock ran out. Trade desks that were open were depleted. It was a narrow exchange. Furthermore, only those already in a position might acquire substantial quantities. Since XRP is useful for real-time settlement, it will likely follow a similar path, but at a far faster speed. In contrast to Bitcoin's primary use as a store of value, XRP's demand is based on practical throughput, plus that alters the whole situation. Speculators aren't the ones buying. In order to function, these entities require liquidity. Such customers don't buy little when they step in. Operations, future scaling, corridor development, and reserve buffers are all covered by their purchases. For XRP's scarcity, that is sufficient. However, scarcity is merely the surface level. The second effect is that anchoring retail prices no longer works. Retail investors anticipate a gradual ascent of XRP. The price gradually rises, with good pullbacks in between, from $5 to $10 to $20 to $30. However, a supply shock acts differently than a typical pump. Like a repricing event, it goes on and on. The rising market is irrelevant. The story goes like this. The market immediately recalculates after recognizing it mispriced the asset for years. This is how asset prices can rapidly and arbitrarily jump from one range to another. They are unable to grind through resistance levels since the liquidity that typically generates such levels has disappeared. Due to thin order books, a tiny quantity of money can have a large impact on price. Additionally, whenever institutions notice that additional supply isn't returning to exchanges, they revise their models accordingly. This occurs when the price increases at an exponential rate that the retail sector finds incomprehensible. Most people are caught unawares by the third consequence, which is psychological. The general public's investment confidence in XRP plummets as its availability declines, not because it's expensive, but because they've just realized there's no way to get their hands on the asset at a price they're willing to pay. A wave of demand driven by fear, not FOMO in the conventional sense, but fear of being permanently excluded, erupts as a result of this. Assuming there will be just one more sell-off, correction, or opportunity, people start frantically reloading charts and checking every exchange in the hopes that it will materialize. Ironically, the supply shock is accelerated even further by this panic demand. Whenever an asset class went from being in its infancy to being considered institutional grade, this pattern was there. Once the door closed, there was no turning back, whether it was for Bitcoin, rare commodities, land, metals, or even stocks before they were widely available. The entries that retail were anticipating were never sent. Their expectations were not met by reality, which caused them to be priced out, rather than a lack of desire. An increase in secondary price premiums is the result number 4. Alternative markets start to give the asset a premium when the asset's liquidity on the main exchange is low, or when trading is temporarily suspended owing to overload. This could lead to a discrepancy between the advertised price on major exchanges and the price customers pay on smaller sites. During supply squeezes in the early days of Bitcoin, premiums might reach as high as 80% across different countries or exchanges. Because supply becomes the main concern, retail investors may be compelled to buy at even higher prices than what the official chart indicates if XRP undergoes a similar phase, which is quite probable. When access is prioritized over price, liquidity becomes a privilege instead of a default. The demise of trading tools that are accessible to regular investors is another unintended consequence. Limit orders, supply laddering, DCA, hedging, and risk management are all possible in a liquid market. However, this becomes much more challenging when the liquidity of XRP runs out. Unfortunately, we may not be able to fulfill your requests. You can see a price spike that exceeds your entire budget. A terrible slippage ensues. People who trade in an atmosphere where options are plentiful suddenly find themselves in a world where options are scarce. Because of this, retail is structurally priced out by the supply shock, not only monetarily. One of the most baffling parts of this whole thing is the part that liquidity providers play. Institutional desks, liquidity providers, and market makers mediate transactions between sellers and purchasers. They keep spreads at an acceptable range. Depth is managed by them. They level out fluctuations. Liquidity providers, however, encounter new motivations in the event of a supply shock. Market makers would be foolish to maintain large quantities of XRP on exchanges if the price is going up and liquidity is going away. They extract funds. Access is restricted. Their spreads are widened. Large orders are also started to be limited by exchanges. Because of this domino effect, regular people can see XRP but have no idea how to use it. Not because anything is wrong with the system, but rather because it has progressed beyond the point where retail access is the primary focus. This is the turning point when it all becomes clear. Markets that have entered institutional territory cannot be re-entered. You only get one shot at amassing an asset before it's absorbed by infrastructural needs. The market then changes into a new setting with its own set of regulations. The ultimate consequence, the irreversible change in storyline, hits home here the most. Everything will change once XRP is mostly held by institutions. Coverage in the media shifts, analysts' predictions shift. Models of liquidity are dynamic. After first being seen as a speculative gamble, the asset is now seen as an essential instrument for financial analysis. Plus, once that storyline takes shape, ordinary people can't control the market price. They stop taking part and start watching. Just before XRP reaches infrastructure grade and the liquidity window closes, there is an opportunity. Simply said, that window will never open again after it shuts, according to history. Get XRP Insider's Elite if you wish to be ahead of the curve when the next major financial change occurs. You will be privy to techniques used covertly by the crypto elite, exclusive XRP insider notifications, and the frameworks utilized by billionaire investors to create wealth that lasts generations.